Let's talk chapter 4 of our book. Corporations, organizing the capital structure is the topic. I'm going to skip a couple of slides here and just get down to where I want to start, which is right here. So we have an example here of we are going to start a donut shop, and you can see that we're going to have some assets donated at a tax basis and a fair market value. You can see furniture, cash, furniture and fixtures and building, total of 70 versus 170 between the tax basis and the fair market value. Section 351, without that there's a gain of 100,000. With it, no gain or loss. Ron's economic status is not changed. So section 351, in general, there's no gain or loss on two transferors on transfer of property to a corporation in exchange for stock. If immediately after the transfers are in control of the corporation. So, clearly just kind of think about just what happened here with Ron and his donut shop is he is setting up a donut shop and he is contributing things he already owns to the donut shop, which makes sense. And of course what he's doing is valuing those things at their fair market value, because GAAP accounting says, oh, we need to value these things at what they're truly worth. And so for GAAP to set up your company, you're going to use a value of $60,000 for the furniture and the building of $100,000, because that's what GAAP says. So the tax basis is just whatever his basis was in those things. What he paid to acquire them is most likely what his basis is, minus any depreciation he's been taking for his personal taxes. So section 351 just basically says because he is now controlling the corporation, there's no gain on the transfer, because ultimately his economic situation is not changed, right? If there is a boot, if property other than stock is received by the transferors, then a gain is recognized up to the lesser of the boot received or the realized gain, with no loss being recognized. So in terms of just forming a corporation, just some issues to think about that we need to be aware of. It says here that the definition of property is cash, a secret process or formula, unrealized accounts receivable, which are for cash basis taxpayers, and installment obligations. The code specifically excludes services from the definition of property, so we don't look at services. Stock transferred can include common and most preferred stock. Does not include non-qualified preferred stock, which is kind of similar to debt. Does not include stock rights or stock warrants. Does not include corporate debt or securities, which are basically bonds, which all those would be treated as boot. In other words, then there would be a gain. We're skipping the big picture thing there, so I'm just going to get past that. There we go. So some other issues regarding formation. The transfers must be in control of the corporation immediately after exchange to qualify for non-taxable treatment. Okay. So the transfers must own 80% of total combined voting power of all classes of stock entitled to vote, and 80% of total number of shares of all other classes of stock. So the 80% rule is one to keep in mind. Immediately after the transfer, does not require simultaneous transfer of more than one transfer, and the rights of parties should be outlined before first transfer, and the transfers should occur as close together as possible. Okay, so whatever these items being transferred in the corporation are should happen, the timing should be very, very close when it happens. Okay, and before the transfer happens, what are the rights of the parties doing the transfer? Clearly having these things written down would be a good thing. So after control is achieved, it's not necessarily lost upon the sale or gift of stock received in the transfer to others not party to the initial exchange, but disposition might violate section 351 if it was prearranged. Transfer of properties and services may result in service provider being treated as a member of the 80% control group, taxed on the value of stock issued for services, not taxed on value of stock received for property contribution. So there's a difference between services provided an actual assets contributed. All stock received by the person transferring both property and services is counted towards the 80% test. To be considered a member of the 80% control group, the service provider should transfer property having more than a relatively small value. So just basically value property with some true value to it, not just some token amount. And we're going to skip the big picture thing here. Okay, so let's talk about then finally about regarding formation. Subsequent transfers to existing corporation, tax-free treatment still applies as long as transfers and subsequent transfer own 80% following exchange. So subsequent transfers can happen as long as we're still meeting the 80% rule.